TJ Maxx reported a solid quarter, increased their dividend, and announced a new buyback program. But the stock's down today, Stephanie. Why is that?
Well, it's been just a home run. You know, the stock's up 8.5% year to date. It was one of the best performing retailers last year. In fact, off-price retailing, those stocks like Ross Stores included, they've really been great performers over the last couple of years. And a lot of that is because these companies tend to offer great value, great product, and they still have square footage growth. So I just think it's a little bit of selling on the news.
So do you think there's risk to the downside here? I mean, the stock is still, even though it's down today, it's still pretty close to the 52-week high.
Yeah, well, you know, and that's a good question. You know, it's trading at about 14 times forward estimates. That's about in line with its historical average. The company is guiding for 8 to 13% growth for the year, which I think is conservative. They just posted 17% in their last quarter. So this is a company that, again, they kind of under-promise, over-deliver, and so we're looking to buy the stock should it pull back, you know, into the low 30s.
Speaking of conservative guidance, their February comp, they said, is trailing at 7%, but they guided the first quarter sales to 2 to 4% increase. Where's the disconnect there? Is it just February is benefiting from the better weather?
Well, I think a lot of it is better weather, and then again, I think a lot of it is, you know, just them being very conservative, which is why it's kind of silly for the stock to be trading down, right, on the news. But I understand it. This is one of the companies that they've got not only growth in the U.S., but they also have opportunity internationally. I mean, one of the big knocks on the stock, if you can say anything really wrong with this, is that they've had to restructure Canada and restructure Europe. Well, the numbers actually came in really strong for Europe, up 10% a comp in the last quarter, and Canada up 3%. These were you know, versus difficult comparisons. So I think that, you know, this story, there's growth here in the States with Maxx, there's growth from the restructuring, and again, to your point, I think they're just being conservative. That's typically the way management is.
You mentioned Europe, they hit it out of the ballpark with a 10% comp. Is that sustainable given the debt crisis situation there?
Well, yeah, I do think it is. A, we've got very easy comparisons over the next couple of quarters, right? Because they really didn't do very well last year. But B, you know, in a recession, this company does tend to do well as consumers look for the bargains and the values, but they don't want to sacrifice on merchandise quality. And they have a new person running the European division, which I think is a brilliant move and a very proven individual who I think is really going to turn this story around, getting better merchandise in the stores and controlling inventories.
So how do we play the stock here?
Yeah, so I mean, you know, we're up quite a bit. We're about 25% in our position, so it's hard for us to buy around here, but I do think low 30s, you've just got a dividend boost, you just got a new share repurchase program. So I think that there's stuff to get excited about. And again, I think the macro picture, both here and abroad, works very well for this story. So, you know, low 30 for buyers.